So, let's talk about the wheel strategy. I had the idea of making a video on the wheel strategy because when I run a poll in my option trading one-on-one group on Facebook, I've seen that a lot of people were willing to learn more about the wheel strategy. And it's probably one of my favorite strategies overall when I'm using options. That's why in this video I wanted to share with you what is my thought process, what is my workflow when I'm using the wheel strategy, because you'll see there are some things that you need to pay attention to. So at the end of this video, you'll know better how to use the wheel strategy for yourself. But before diving into this video, if you'd like to see more videos like this one where I share my workflow, my thought process when using some strategies, please consider subscribing to my channel. That's the best way to let me know that you'd like to see more videos like this one. The wheel strategy is the strategy that we can break down in 6 major steps. It's a strategy where you're going to have a mix of selling puts and selling calls, and we're going to go step by step so you can fully understand everything. There's 6 major steps to the wheel strategy. The first step is to sell a cash secured put. A cash secured put is simply selling a put and simultaneously setting aside enough cash to potentially cover the assignment. Then after that, it's about rolling and avoiding the assignment. That's really the step 2. We're going to try to roll our put and try to continue generating that income. And then in step 3, it's about having your put being assigned. And then in step 4, it's about selling calls against the shares that you got assigned when you got assigned on your put. Then in step 5, it's about rolling your call again so as to try to generate more income from the wheel strategy. And then in step 6, finally, it's about letting your call being assigned and selling back your shares. So obviously I'm going to go into more details and I'm going to walk you through examples so you can fully see what is the wheel strategy, but it's really to give you an overview at first about the 6 different steps. And before diving into really the core of the strategy and how I personally use it, know that at least for me, the goal when using the wheel strategy is to really squeeze as much premium as I can. And if I could give an analogy, it's a bit like each step of the wheel strategy was like a lemon, and you were trying to squeeze as much juice as you can from each lemon that you have. And that's really the thing that I'm trying to do with the wheel strategy. Before going on to the next step, I want to make sure that I've squeezed as much premium as I can from the current step before going on to the next one. And don't worry if it doesn't make sense so far, you're going to understand when we're going to go through an example together. And to go through an example, I've chosen the stock Twitter, for example. By the way, if you have a small account and you really don't have much buying power, then I have a very good news for you. If you go into the first link of the description and you click on it and you open an account with Webull and only deposit $100, then you're going to be given 4 free stocks valued to $1,600 each. Webull has invited me to partner with them so as to offer you some free stocks. So if you'd like to benefit from it, just go down below in the first link of the description, open an account and deposit only $100 and you'll be given 4 free stocks. That's actually a very good promotion. So as you can see right now, we are in the option chain for Twitter. And the first question that we need to ask ourselves, even before considering using the wheel strategy, is which type of expiration should we choose? Should we go for longer dated expiration? Should we go for closer dated expiration? And here's how I think personally about the wheel strategy and how I choose personally my expirations. When you go for a closer dated expiration, meaning for example the January 29th expiration, which expires in 7 days, then I'm able to execute the wheel strategy much faster compared to if I was, for example, choosing an expiration that was expiring, for example, in March 19th, meaning in 56 days. Because the thing with the wheel strategy is, as we're going to have to roll puts and calls, if you go for a very longer dated expiration, the wheel strategy is going to take a much longer time so as to actually be executed. Because let's say that we go for the March 19th expiration that expires in 56 days and you have to actually roll the puts, then you're going to have to roll it to a much longer period, and that's going to be really long for you to really execute efficiently the wheel strategy. It's probably going to take several months compared to if you go for example, a closer dated expiration like January 29 that expires in 7 days, then the wheel strategy is going to be much faster to execute. For example, if I decide to go right now for the January 29th expiration and I go into step 1, which is selling a cash secured put, and it happens that the stock goes down and my put goes in the money, then I just need to roll my put onto the next expiration, all of this for a credit if it's possible, or maybe for example to the next week. And by doing this, by going for a closer dated expiration, I'm able to roll my put much quicker and I'm able to execute the whale strategy much faster than if I was going for a longer dated expiration. And personally, I think that I prefer going for a closer dated expiration so I can execute the whale faster. And I think that for smaller accounts is also true, because if you go for a longer dated expiration and you have a very small account, it's going to block your capital for a much longer time. Compared to if you go for a closer dated expiration, then you have the potential to execute the whale at a much faster pace. So let's say that we go for the January 29th expiration. It expires in 7 days, and now we look at the option chain for the January 29th expiration. The first step of the whale strategy is to sell a cash secured put. So when we sell a cash secured put, then we need to understand, after having understood which expiration to choose, which strike are we going to choose. And here it's the same thing. There's plenty of different choices possible. It's more about what you like and what you'd prefer doing. I like to focus on strikes that are usually around the 30 delta. And why the 30 delta? Because the 30 delta roughly equals to 30% probability of being in the money. And why? Well, because delta can be associated to the probability of expiring in the money. Because if you choose a strike that has a delta of 30, then that strike has around 30% chance of expiring in the money. It's a quick tip to know what are the probabilities of expiring in the money and out of the money. And when you sell a put, you want your put to expire worthless. Hence, you want your put to expire out of the money. So if I decide, for example, to sell the 30 delta put on Twitter in the January 29th expiration, and I look at what is available, and I see that the closest strike available to the 30 delta, as you can see on the right, is going to be around the 45.5 strike. So you see that that would be the closest, because otherwise it goes to 27 and then 41. So that's really the 45.5 that I have, that is the closest to the 30 delta. After that, nothing prevents you from going further away out of the money, meaning that if you want to go for example, a 20 delta or 15 delta or 5 delta, meaning that you have more and more probabilities of expiring out of the money and so making a profit, that's completely up to you. However, you need to understand that the further out the money you go, the less premium that you're going to make. That's why I think that the 30 delta is overall a good balance between having enough probabilities of winning, meaning that you have around 70% chance of winning your trade, and also you collect a good premium, meaning that you're going to make a good profit if you win the trade. So in our case, at the 45.5, if I decide to sell a cash secured put at this strike, I click here and I see that I would receive around 65 cents of credit, meaning that if I win the trade, I would collect $65, meaning that I would earn $65 of profit. And a quick tip to understand what is your return on investment: just divide the credit that you're receiving by the amount of money if you were being assigned, meaning that here, in that case, as I'm choosing the 45.5 strike, if I was being assigned at that strike, I would need to provide 100 shares. I would need to buy 100 shares at a cost of 45.5, meaning that I would need to pay $4,550 if I was being assigned. And if you divide 65 by 4,550, you're going to see that it's approximately going to give you a return of 1.3%. And it's really a good return, especially when you consider the fact that the expiration itself is expiring in 7 days, meaning that you're making 1.3% in the next 7 days if your put expires worthless. So the first step is to sell a cash secured put, and we have our cash secured put. I was, for example, going to sell the 45.5 strike, collecting a credit of 65 cents. And then after that, we go on to the step 2. So the step 2 is about rolling your put and trying to generate more income from the whale strategy. And our put has basically 2 outcomes possible. Either it expires in the money or it expires out of the money. If it expires out the money, then great, meaning that we keep the full premium, we make a full profit, and you just keep selling another cash secured put and you go back to step 1. And if it expires in the money, it means that we're going to have to buy the 100 shares at the strike price. However, remember that I said with the analogy of the lemon that we're trying to squeeze, we're going to try to roll our put to a later expiration so as to really try to squeeze as much profit as we can. So if we see that our put is going in the money, meaning that the stock falls, then we're not letting our put expire in the money directly. We're going to try to roll it out maybe to the next week so as to collect a bigger credit. And how do you know if you should roll it out or maybe you should let it expire in the money? Well, after having done it probably several times, you're going to see that it's going to become quite hard to roll it out either for a credit, or meaning that if you can roll it out for a credit, it's going to take like 6 months just to expire. And then you need to ask yourself, is it worth making few bucks and having my put expire in, for example, 6-7 months? If it's not worth it, if you see that you're really going to make little money for a duration of like 6 months, then you might let it expire in the money. And in that case, we go to step 3. In step 3, it's about having your put being assigned. If our put expires in the money, then we need to buy 100 shares at a cost per share of 45.5. And that's going to be $4,550 worth of assignment that we need to provide. And once you have the 100 shares, then great. Now we can go on to the step 4 of the wheel strategy, which is about selling covered calls. Selling covered calls is just simply selling calls against the shares that you own. And here, the same thing again. So let's imagine that now I have 100 shares of Twitter at a strike price of 45.5. And now I'm going to sell calls against the shares that I own. I'm going to go around the 30 delta, for example, and I'm going to start selling calls against the shares that I have. And here you see that I actually collect a credit of 65 cents if I sell a call around the 30 delta. So I have a probability of seeing my call expiring worthless of 70%, around that. And I'm going to make $65 if my call expires worthless. If it expires worthless, then great. Then I just need to sell another call and I'm going to reduce my cost basis that way. And if my call goes in the money, meaning that the stock goes up, then I'm going to try to roll my call to a later expiration, just to try to squeeze as much premium as I can. And once again, like in our example of the put that we were going to roll, you need to ask yourself, is it worth it to roll my call to a later expiration? If it's not worth it, meaning that you're going to make a few bucks over the next 6 months, then it's probably better to just let your call expire. But if you can roll your call to, for example, next week's expiration and still make a good amount of money, then just roll it out for the next week's expiration and you're going to collect a new credit for that. And once you will have done this over and over, at some point your call is probably going to expire in the money, meaning that you will be assigned on your call. And when you get assigned on your call, you have to sell 100 shares of the stock at the strike price. And here in our case, as we have 100 shares of the stock because we got assigned on our put before, then we're going to be assigned on our call and we have to sell 100 shares of the stock. And luckily we have the 100 shares, as I said, so you're just going to end up flat in the end in terms of shares that you own, because you had previously acquired 100 shares with a put assignment and now you're selling them back with a call assignment. And then now you end up with no shares at all and you just go back to step 1 and do this over and over. But you see, I'm not sure if it was completely clear for you in terms of premium, in terms of share price, because we talked a lot about of different strikes and different things to track. And the big trap of this strategy is not tracking what you're doing, because if you don't track what we call the cost basis, meaning exactly the share price and the cost per share that you have with all of the different premiums that you're going to receive, is going to become quite messy quite quickly. And it's very important to track your cost basis, because if you don't, then you're probably going to end up in a loss overall, even though you did everything right, because you didn't track your cost basis and you didn't know how to manage really your cost basis. That's why I've created a spreadsheet so you can track your cost basis. And I'm going to walk you through that spreadsheet so it's very clear for you. And it's completely free, no need to pay for anything. I don't want you to pay for a spreadsheet. The only thing that I could ask in return is if you like this spreadsheet and if you like this video, please consider liking it and subscribing to my channel. That's really, as I said, the best support you can give me. So as you can see at the top, you have the title, the whale strategy, the cost basis tracker for the Twitter stock, for example, because we were talking about Twitter. So here I made that sheet for Twitter. If you were willing to do this for another stock, just duplicate that sheet and just, change the title. Then we have two big columns, the credit column and then the debit column. Because when you receive a premium, you get credited of money. When you pay, for example, during a put assignment, you have to buy shares, then you have to pay a debit. That's why we have those two columns of credits and debit, so you can keep track of what comes in and what comes out. And after that, we see that there are different columns in the credit column, in the debit column. At first, we have the action. As you can see, there are some notes at the top right-hand corner of the, for example, action column, and you can see what are you doing essentially. Are you doing a cash secured put? Are you doing a covered call? Or are you being assigned on your call? That's essentially the three things that you can have in this column. That's why I've put a note, so if you don't remember, you know what to put in. And we have exactly the same on the action column in the debit section. Are you buying to close a call or a put? Maybe are you buying to close a put, or are you being assigned on a put? Because those three choices are the type of choices where you would have to pay a debit. So if you don't remember, exactly as the same for the credit column, then just look into the right hand corner to know what are the different choices that you can have. So let's imagine that we were actually selling a cash secured put and we were doing the whole strategy on Twitter, so you can see how to fit it in. So at first I said that I was going to sell, for example, a cash secured put on Twitter at the strike of 45.5. So at first I'm going to write CSP, and you can see all of the definitions down below. So in case if you want to use acronyms and you don't know what they mean, then you can just see the definition. So cash secured put is CSP. Then you're going to put the date. So let's say the date of today is 21st of January. Then you have the number of shares. If you're for example selling one contract, then you're going to put 100 shares because one contract controls 100 shares. If you're selling two contracts, then put 200 shares. So in our example here, because let's imagine that I'm selling one contract, then I'm going to put 100 shares. Then it's about having the premium or the share cost filled in, meaning that if you sell a call or a put, just input how much credit you received. If you're, for example, selling shares, then put what is the share price at which you're selling your shares. So in our case, I was selling a cash secured put at the 45.5 strike and receiving a credit of 65 cents. So I'm going to put 0.65. And you can see that this total column directly adjusts to $65 because one contract controls 100 shares, so 65 times 100 is equaling $65. So, and here you have the status column that is just here to help you know which put are we actually taking care of. So I've put open here so as to really remember that this is the put that we're actually tracking right now. But then let's imagine that your put actually goes in the money, and because the stock falls down, and you actually have to roll that put. So how would you input that into the spreadsheet? Well, it's quite simple. As you can see here, you have those buy to close put and buy to close call. Then you would use buy to close put and you would go into the debit section because at first you close your current position. So buy to close put, and let's imagine that it happens on the 25th of January. And then it's again 100 shares. Then you input what is the debit that you're paying to buy to close your put. So let's imagine that it would be, for example, I don't know, 1.20, so $120 that you pay so as to close your put. Then you would put close here. You would change the status of your previous put to closed so as to make sure that we keep track of everything. And then because you're rolling your put, after you have bought to close the put, then you're going to sell to open another put. So you rewrite again a cash secured put, let's say at the same day, so 25th of January, again 100 shares. You will input how much credit you received for your new put. So for example, I don't know, 80 cents. And then you will see that now we go back into profit again. And you do this over and over. So we're going to simulate that, I don't know, we do this twice. So I'm going to put close because we're going to do it directly. So let's say that on the 29th of January, you have to close again, buy to close your put because you have to roll it out again. It's 100 shares, and let's say that you have to pay, I don't know, 114 in that case. And because you're rolling it out, you're going to open a new cash secured put once again. So let's say that the same date, on the same date you roll it, 100 shares again, and let's say that this time you receive 76 cents of credit. And here we are now with your put again. And let's imagine that right now your put actually gets assigned because you see that it's not worth anymore rolling out your put again. So you're going to let it be assigned, and meaning expiring in the money. So what happens when a put expires in the money? Because you have to buy 100 shares, you have to pay a debit for that. So what you do, you go down there in the definition and you see that it's about put assigned, which means put assignment. So because you buy 100 shares, you go into the debit section, and here you input in the action column, put assignment. And let's imagine that it happens on the, I don't know, 3rd of February. It's 100 shares that you're buying. And let's imagine that we were doing it around like the 44 strike because you had managed to roll it out to a lower strike, for example. And you input here 44. Because, for example, you have sold a put at the 44 strike, and then this put expires in the money, and you have to buy shares at the 44 strike. So you put 44. And you see now that your adjusted cost basis, your running P&L, is minus $4,413. And that's completely normal because now you have bought those 100 shares. But don't worry. And now, as per the wheel strategy, and in terms of steps, now you will need to sell covered calls. And that's where really tracking your cost basis is really, really important. There is a cell that says sell calls above, and here it says a number. it says 44.13. This sell is really to only be considered if you already got a sign on your put. And that's just a quickly way to know what is the strike that you should sell a call at a minimum. Meaning that if you sell a call below 44.13, meaning let's say you sell the 44 strike, the 43 strike, or the 42 strike, or below, if you get a sign on that call that you sold below that threshold, then you're going to end up in a loss overall. Hence why you want to sell calls above that threshold, above the 44.13 strike, meaning 45, 46, 47, and everything above. If you being assigned on those calls that are above that threshold, then you're going to sell your shares and in the end, making a profit in the end. That's why it's very important to strike your cost basis, and that sell is really here to help you understand what is the minimum threshold that you should try to sell your call at, either that strike or above. So in our case, as per the steps of the wheel strategy, you start selling calls against your shares. So we input CC for covered call, and let's imagine that it's on the 3rd of February, directly when you get a sign on your put, you start selling call against it. So it's 100 shares once again. And let's imagine that we sell a call and you collect a credit of 76 cents, for example. Here you type open to make sure, and here you type close just to make sure we keep track of everything. And what's very interesting right now is that you see that you received a credit of 76 cents, and you see that your cost basis went from $44.13 to $43.37, meaning that each time you sell a call, you're going to reduce essentially your cost basis because you're being paid for that. So you can afford to sell calls at lower thresholds as you collect more and more premium. And ideally, in an ideal world, you would sell so many calls and you would reduce your cost basis so much that in the end, you would end up having the shares for free. Meaning that if you were, for example, selling 43 calls and you would receive $1 each, then you would have reduced your cost basis by around $4,300 and you would almost own the shares for free. That's the thing about the cost basis, and that's why it's so important to track your cost basis. And in our case, let's imagine that once again, you have to roll your call several times. So as you can see here, you would buy to close a call. Let's imagine that it happens on the 6th of February. It's 100 shares, and let's say that you buy it back at a 110. I'm just putting close here. And then you're going to open a new one on the 6th of February for 100 shares. And here, let's say that you're selling it for 87 cents. So you see here that once again, our cost basis got reduced a bit more. If I was just, without rolling, if I were just doing this over and over, look at the adjusted cost basis and look how it's actually being reduced. The more covered calls you sell, you see that your cost basis is actually being reduced. And in the end, your threshold that you need to sell your call at, or at least above, you see that it's actually reducing. Because the more premium you received, the lower your cost basis becomes. And that's why it's very interesting when you track your cost basis, because at least you can know what is really that threshold that you cannot go under at. Now let's imagine that you have around done it twice, and now it's almost useless to sell your call again, like in the previous example with the put, because you're going to have to roll it out for a very long time. It's not going to be worth it. You're only going to make a few bucks over the next month, and you'd rather just let your call expire in the money. And know that it's completely fine. It's completely fine to let your call expire in the money. As long as you have sold a call that is above that threshold, above that strike, then you're going to end up making a profit in the end. Because let's imagine that now your call is being assigned. Then you go here and you go into the call, the definition, and you see call assigned, meaning call assignment. And let's imagine that that call assignment happens on the 12th of February. It's 100 shares. And let's imagine that you had sold it at the 45 strike, for example. If you type 45, so $45 per share, then in the end, you're making a profit of $150 on the whole wheel strategy. And that's very interesting when you look at it that way, because now if we're, for example, if you had sold a call that was under that threshold, so let's say at the 43 strike, you would see that you would make a loss overall of $50. Hence why tracking your cost basis is very important, and you can know at which strike is really the threshold that you should try not to go under. And by always selling calls, you are going to reduce your cost basis, and that threshold is actually reducing. But it's still very important to understand what is that threshold that you cannot go under at when you sell your calls. And so you see with that spreadsheet how easy it can be to really track your cost basis, and you can see how great it is to know what is that threshold that you should try to respect, meaning you shouldn't sell a call that is is under that threshold. You should always try to sell a call that is above that threshold. And the more premium you received, the lower your cost base is. And to access that spreadsheet, just go into the link into the description. And once you have accessed that spreadsheet, click on File, make a copy so it can be copied to your own Google Drive and you can have it for yourself. Or click on File and download. So now that we talked about the wheel strategy, you understand how it works, you understand what are the different steps, and you even understand how to track it, and you even have that spreadsheet. What is the downside of the wheel strategy? Or is there even a downside to that strategy? And well, there is one. If you are being assigned on a put, now you own 100 shares of the stock, and if the stock happens to fall to 0, then you would have 100 shares that are equaling now 0, and you would have lost the value of those 100 shares. That's why it's very important to use the wheel strategy on stocks that you wouldn't mind owning on the long term. But in the end, even if you had bought directly the stock, meaning if you had bought shares of that stock and the stock fell to 0, you wouldn't be in more trouble than if you were actually using the wheel strategy. That's why if you do it on the stock that you'd like to own, it's not going to change at all compared to if you had bought shares of the stock directly. So the only downside is if the stock falls to 0 and you actually own shares at that moment. But as you should use it on the stock that you wouldn't mind owning, it wouldn't be different than if you had bought the shares directly. I hope you enjoyed this video about the wheel strategy, you found it helpful, you found it interesting, and you actually learned something. And as I said, you can find the link of the spreadsheet in the description of the video. If you found this video helpful, please consider subscribing to my channel and liking this video. As I said, it's the best support you can give me, and I'd really appreciate it. If you have any questions, don't hesitate to comment it below. I'll be happy to help. And please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.